Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Well, good afternoon, everyone. Aaron's back in the studios. How's it going, Aaron?
Pretty good, John.
Okay. You know, one of the biggest things that impacts people's lives, we talked maybe last week, is taxes.
Right.
They have a big effect on your retirement plans.
They sure do. I think that's one of the big discussions that people are shocked about when they go see a financial advisor. I know I talk about it probably ad nauseum, and people, but they get it, because we go over the tax return every time they come in. Almost every single time somebody comes in, which is twice a year with me, I look at their tax return. If I hadn't seen it yet for that year, they bring it in and we go through it. It's just line by line, and most of our tax returns are very not complicated, I should say, especially for retirees. They have pension or IRA distributions, Social Security. Sometimes you have your farmers or small business owners gets a little bit more complex, but most of us have straightforward tax returns, and it's very much an eye-opener for people to see, that's how that works. Oh, that's why we do it this way. I see. And the thing is, we have a discussion about it. If I did it once every 2 or 3 years, we wouldn't remember that conversation. They wouldn't. I remember it because I have it every day. I have this conversation with people every day. Accountants do this work every day. So you understand it's our job to be up on that. But we want to educate. I certainly do want to educate my clients. And then you have those questions throughout the year. We might be able to, make some changes or adjustments and make sure that you're paying the least amount of tax that you owe, if any. Sometimes we can get under that, get to that zero number. But showing people that, what their effective tax rate is or their real tax rate is, on 50,000 of income or 100,000 of income, it helps, I think, get you to that thought of, where do you see me? They ask me this, where do you see? Is that a lot of taxes? Is that, I say, no, I don't know what that exact number is, but I always tell people, if you can get under 10% in an federal effective tax rate, you're doing pretty good. But, we got to watch that state tax return. We have this retiree tax. I know I've complained about that since the law was passed, and I'm hoping this governor and legislature will get together and fix that. But we are focused on that. And another is a focus is the state property tax credit. So I go over the tax return and make sure that people understand how they're getting that or if they're getting that. I can tell you right now that most don't know that receive it, don't know what it means or how they get it or why they get it. So we go through that. And then I find others, and there's been a few that, because the software systems that accountants use, it's all the technology catches that and just, gives you the credit or doesn't give you the credit. But there's been a couple where I found that because certain information like the value of your home wasn't entered properly, that the person didn't get the credit. So, or they didn't take the property tax statement with them to their accountant. I make sure that, and I ask them about that. Is this all, might bring in their entire tax return to me. Is this everything that you gave to your accountant? Yeah. So then I can kind of, through deduction, figure out it's probably because they didn't put that property value on your tax return, and that's why you're not getting the credit. So I catch those things, and it's interesting because sometimes I'll call the accountant while they're in there, and the accountant will set me straight, which is good. I like that because I'm learning too throughout the process, especially with the new tax law changes. But you should be asking those questions, and I tell especially farmers or business owners throughout the year, and I know they're already having those meetings with their accountant, but make sure it's a good substantive meeting, it's a good quality meeting, and they're taking that time to go through things and explain to you, what your opportunities might be that you might not be aware of. So,
And you need to do that every year, because every single year somebody does something tax-wise that affects you.
oh, absolutely. Absolutely. I think there's going to be another change on the 1040 this year. So everybody in our business, will be waiting for that change, at least to the look. The law hasn't changed, but the look of how they like group things together or separated things. And I know accountants out there, I hear it all the time. And of course, me too, when I'm looking at tax returns, these schedules. So they reduced the 1040 down to pretty much, remember that postcard conversation? It's about that size, or can be. It's half a page. But all they did is just added schedules, schedule 1, 2, schedule 3, schedule 4, schedule 5. I mean,
Right. They added pages somewhere.
It's funny because I've had many accountants say, we got more paper now than we did, before the law was passed, and supposedly it was going to reduce that. Kind of funny. So let's talk about an opportunity to withhold taxes on your required minimum distribution to simplify paying your taxes. So a lot of retirees out there and accountants are very clear that if you owe a certain amount of taxes every year, you have to pay estimates. If it's, there's some calculations there that, if you owed, $200-300, you don't have to file an estimate. But if you owe $2,000-3,000, you may have to do estimates. So the software spits out the estimate payment vouchers, and then your accountant just gives them to you, and you're supposed to write a check, and send them in on time in the months of April, June, September, and then January to catch the last quarter of the year. So it's a quarterly estimate. The reason it's done that way is because the IRS, or the law, says you have to pay your taxes, or a certain amount of taxes. Let's say it's 90% of what you owe in that particular quarter. And if you don't, you could be subject to a penalty. You got to pay that tax, and you could be subject to a penalty. So here's a thought of a way to simplify paying those taxes, as I said at the beginning. If you're getting a required minimum distribution, take that distribution toward the end of the year. So right now in our office, we have compiled, usually October 1st, the last quarter, we compile our list of who has not taken their required minimum distribution. So we focus on managing that required minimum distribution, the taxes that you owe, and make sure that it gets paid, right? Because there's a huge penalty if you don't take that required minimum distribution. Talking about taxes, though, an option would be you're 70 and a half or older, you got to take that minimum distribution. You could focus on taking that entire year, paying that entire year taxes with just that required minimum distribution. The IRA distribution, the law for IRA distributions requires that 10% be withheld unless you tell the custodian otherwise. And the custodian is a brokerage firm, is a bank, typically. But you can block withhold altogether everything that you owe, and you can do as much as 100%. Now, I've said this in the past about doing 100%, and some companies say you can't do 100%. You can do 99.9, or you have to take $1 fine, just so you know that you can withhold a lot. So if you're getting an RMD of $6,000, and last year you owed $5,000 in federal taxes, you can do a 100% withholding rate on your RMD. It's a great way to manage cash flow too, because your Social Security, you're getting all of that. Your pension, you're getting all of that. Any other distributions you might be getting, you're getting all of that. It's all going into your bank account, and it's a great way to budget and manage your life, because that's how we did it when we worked. We get a paycheck, and that paycheck, already had taxes removed, everything done. And I said a better way. So another way is just do a withholding, right? You can do a withholding on your Social Security, and they have a form. It's called the W4V, as in Victor. You fill that out. They only allow you to select a certain percentage. So you can check the box 7%, 10%, 12%, and 22% of each monthly benefit. They'll carve that off and send it to the feds, and there's your tax withholding. I think it's a much, much better way to do your tax withholding from some other source, because it's very possible that Social Security income is not taxed, or it's taxed at a lower rate. So it doesn't, you're either over withholding, or you again went back to under withholding, and you're back in the same problem. And it becomes more complex. And I said right at the beginning, we're going to talk about simplifying. So talk to your advisor, come see me, talk to me. This is what we do for a living. We manage this and make sure that find out what is in your best interest, and then find out mentally what you like.
So in other words, if you have a minimum distribution, you
Yes.
can wait until the end of the year to take that distribution, and by then you should have a pretty good idea of what you're going to have to pay in income taxes,
That's right.
and you can take care of it all right then.
That's right. The first year, it's a little bit more confusing at first and complex. Usually the conversation is leading up to the year you turn 70 and a half. Now remember, at 70 and a half, you're going to figure out, okay, you got a $300,000 IRA. The first year you got to take 3.65%. So that's somewhere, let's say $10,000, $12,000. Wait a minute. I have to take it? Yes, you do. What do you mean I have to take it? Well, I say you have to take it. It has to come out of your IRA as a distribution. Now, if you want to put it into another investment or not use it, that is your prerogative, but it has to go on your tax return as a distribution. If it's not there, that could be a problem. 50% penalty, and then as soon as you start talking like that, okay, I'll take it, right? But we got to manage that. Okay, we got to do a withholding on that. But what happens is it takes all that other income that you have, and it changes or could change your tax bracket, right? You could go from a 10% to a 12%. So, any dollars over that in that bracket of 10% is going to be taxed at 12%. And then if you get up to the 22%, it really changes that picture. I also talked about, depending on how much Social Security you receive, how much other income that you receive, it could make your Social Security taxable. That $10,000 extra dollars could push that Social Security or a part of it to be taxable. So it's not just that you're in the, a 10% bracket. Now you're making more of your Social Security taxable. So all of a sudden you went from paying $0 or $500 a year in taxes to owing $2,000 a year, and you're shocked. That's the stuff we need to plan for. So the first year you turn 70 and a half, we can work through that, talk about it. But I think what happens later on is most people, they don't want to take the money in the first place. So delaying it is okay. And then when you say, it might be to your advantage to delay it. So, a win-win, right? Mentally, I feel better because I've left it in the stock market. Maybe that's what you think, that, the possibility for gain and opportunity is there if you leave it invested. The whole idea of what I'm talking about is, manage taxes within the law that benefits you. The best way you can do that. That's what we do in our office. 80% of the people do it the same way. I'd say 80%. But there is that 20% that, boy, I start smiling like, I am so glad we're talking, because I am interested in seeing how we can, get a solution for you, resolve this issue. They didn't even know they had one.
It's a great vehicle, and once they do it the first time, it kind of goes on autopilot after that. You don't have to worry about it.
That's exactly it.
Well, if they want to get that checked out, Aaron, how can they do that?
Give me a call, 265-3540.
All right, Aaron. Thanks a lot.
Thanks, John.
That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.